This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
The Red Sea's shipping tensions are causing discord in the global oil market, with major logistics groups like Maersk, Hapag-Lloyd, and Mediterranean Shipping Company rerouting traffic around Africa. The daily container capacity of ships in the Red Sea and Suez Canal area has fallen to just one-third of normal levels, and the number of tankers in the canal has fallen over 50%. The impact on global prices is complex, with freight rates for tankers rising by 30% since mid-December. Russian crude oil has increasingly dominated flows headed east to China and India, the world's top oil consumers, who have not sanctioned Russian supplies. This could present an opportunity for Saudi Arabia, whose tankers to Asia don't need to pass via Suez, to prop up oil prices.
Oil prices eased in early trade on Tuesday as anxiety over the global demand outlook for oil offset geopolitical tensions in the Middle East and supply worries following an attack on a Russian fuel export terminal over the weekend. Brent crude futures fell 14 cents, or 0.2%, to $79.92 a barrel by 0125 GMT, while U.S. West Texas Intermediate crude futures, WTI, were last down 10 cents, or 0.1%, at $74.66 a barrel. Both the contracts had settled about 2% higher on Monday, as a Ukrainian drone strike on Novatek's Ust-Luga fuel export terminal raised supply concerns and drove up prices. Analysts say Novatek is likely to resume large-scale operations there within weeks.
Moving on to the top news in the energy sector.
Saudi Arabia's crude oil exports in November climbed to their highest level in 5 months and marked a third straight rise. Data from the Joint Organization's Data Initiative, JODI, showed on Monday. Crude exports from the world's largest oil exporter rose 0.6% to 6.336 million barrels per day, BPD, from 6.297 million barrels of oil per day in October. Production fell 1.4% to 8.818 million barrels of oil per day. In November, OPEC Plus oil producers agreed to voluntary output cuts totaling about 2.2 million barrels per day, BPD, for early 2024, led by Saudi rolling over its voluntary cut.
The Brent crude market structure and some physical markets in Europe and Africa are reflecting tighter supply resulting partly from concern about shipping delays due to vessels avoiding the Red Sea, according to traders, LSEG data and analysts. The disruptions have combined with other factors such as outages and rising Chinese demand to increase competition for crude supply that does not have to transit the Suez Canal, and analysts say this is most evident in European markets. In a sign of tighter supply, the structure of the benchmark Brent crude futures market hit its most bullish in 2 months on Friday, as tankers diverted from the Red Sea following airstrikes by the United States and Britain on targets in Yemen. Next, we have the top news in metal markets. Uranium prices have hit their highest in more than 16 years on a buying frenzy triggered after the world's largest miner of the nuclear fuel highlighted production risks. But the price surge is likely to mean the restart of mothballed capacity. Kazakhstan's Kazatomprom earlier this month said it may cut its 2024 production plan due to difficulties with the availability of sulfuric acid needed to produce uranium. Uranium oxide prices, under pressure for years after the Fukushima nuclear accident in 2011 battered demand, picked up momentum in August 2021 when disruptions caused by COVID lockdowns hit supplies and created shortages.
Until zinc demand picks up significantly and the market stops focusing on projected surpluses of the metal used to galvanize steel, price rallies triggered by production cuts are unlikely to be sustained. On January 15, NYR Star announced it would suspend its Boodle smelting operations in the Netherlands due to high energy costs. Zinc prices on the London Metal Exchange, LME, on that day hit $2,615 a metric ton, the highest in more than a week. But since then prices have dropped 6% to around $2,450.
We will now look at the top news in the agricultural sector.
Forecasters expect lower production from Brazil's second corn crop because of smaller planted area, lower investment by farmers, and the intense El Niño weather pattern, which brought drought to central Brazil and excess rains to the south. According to a report by agribusiness consultancy Kogo on Monday, Brazil will reap 118.5 million metric tons of corn in the 2023-2024 crop year, down from an initial expectation of 129.6 million tons. The projection reflects an 11% reduction in the estimated area for first corn, planted in the Brazilian spring. For second corn, which represents 75% of annual production and is ideally sowed by mid-February, farmers are expected to cut the planted area by 5%, Kogo said. That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.